It's the beginning of August, and you know what that means. Summer's on its way out, and fall is on its way in, and we have July numbers to go over to see what the Denver real estate market is doing. Are we going up in price, down in price? Did the July gloom kind of hit like it normally does, or was inventory low enough to kind of keep things stagnant and stabilized? Well, I haven't looked at the numbers per usual, so we're going to look at them together, kind of analyze them, see what's going on, look at a few headlines out there too to see what the majority of people are seeing, to see how it might affect the fall going forward as well as the winter, because normally we drop by about 5 to 7% in price. Are we going to have the same thing this year, or are we going to have it a little more drastic like we did last year? We don't know until it happens, of course, but let's get into it, and starting with what everybody wants to know, of course, closed price. Coming over here, looking at the median closed price from June last month of 2023, we're at 575. July, 575. Now we're looking at a chart here for the last 3 years. Let's zoom out a bit and take a look on a broader time frame to see, is that the norm or is that not the norm? So last year in 2022, the peak was April. As we know, it's 600,000. The year before, looks like June was the peak. Year before, actually in 2020, but nothing's normal about 2020. Forget that. May was the peak in 2019. May was the peak in 2018. June was the peak in 2017. So we're not too far off here. June, July being flat. Once we hit July, we usually start ticking down a little bit year over year. So the fact that we did hold flat is actually a good thing in my opinion. Now we are still down from all-time highs of 600. We're at 575, so down about 25,000. What is that? 3-4% or so down from our peak back in April of last year. But from last year, what were we at? We were at 575 last July. So the headlines are going to say 0% appreciation over the last 12 months in the Denver market, when in reality, we went down by about 15%. Then we've gone up by about 10%. So remember, figures can't lie, but liars can figure. On to new listings. So June, we had 8,800 new listings. July, 7,500. So that's quite a few less people putting their house on the market by, 1,300? So well over 10, 15, maybe 17-ish% less new listings in July than June. What's the norm? Let's go take a look. Last year was our peak of new listings at 11,500. July was down 9,700. So compared to last year, we've got 20% new listings in July than we did last July. Now, the year before, June was the peak. Then we dipped down in July. So July was the peak of 2020, but abnormal year. So I would say that's pretty normal. What's not normal is total of new listings hitting the market. So let's zoom out here a little bit. July, we had 7,500 new listings hit the market. The last time we had that few new listings hit in July, was back, 2012. So it's been over a decade, folks, since we had this few new listings hitting the market. Pretty fascinating. And there's a headline actually that's driving this, and I'm going to show it to you here in a few. We'll discuss it as, we kind of take a look forward and try to predict what is coming up for us. The amount of active listings. So here we did pretty much go flat. It looks like June we had 12,000 active listings total, and in July we had 11,900. So virtually flat. I don't think that's anything to write home about. Zooming out on this, we can obviously see the wave of when it happens, but we usually start to drop in July. So this is something to pay attention to here as we go forward. If we don't start to dip in the amount of active listings and we do continue to climb and closed listings drops, that's probably going to put some pressure on prices downwards. Let's look at pending listings. So here we can see, we've almost been flat since April, May, June, and July have all just been between 6,000 to 6,500 pending listings, which is not very normal. We usually see the climbs and the falls pretty drastically, which what should be mimicked is next closed listings. But interesting here, closed listings isn't mimicking the pending listings mimicking. The same amount of pending listings per month, 6,500, 6,400, 6,300, 6,000 cap for the last 4 months. Closed listings have been 5,800, then 6,600, 6,700, boom, 5,142. So that's interesting. What that might tell me, and I'm going to dig into this further, is if a bunch of under contract properties came back on the market, right? We had some interest rate hikes this last month, but to have this many fall out of contract and not get to closing from June. So this is how I look at it. Pending listings in June would equal closed in July, right? The only thing that would prevent a house from being under contract in June to not close within 30 days later is either a domino effect transaction, right, where there's multiple purchases and sales in that, and things get delayed a bit. So instead of a 4-week close on average, maybe you have a 6-week close, right? So that would push off that closing until August. Or B, you have a bunch of properties that were under contract that then fall out of contract due to various reasons, whether that's inspections or financing. Or C, you just have long closing time frames, which doesn't seem quite normal. So I really can't say that that's the norm. So this will be one to watch here under closed listings, because 6,300 under contract in June should probably equal somewhere around that 6,000 mark in July, right? Maybe a little bit more. So we should be flat again, but yet we see a dip all the way down to 5,100, which is fairly low. Okay, so that's on closed listings. Let's pay attention to that. Let's zoom out on this a bit and take a look back. So the low tends to fall in January, okay? January, like that's the low of the close season. Usually it falls around 3,000, okay? And it peaks up a little bit, but we're already at 5,000, where normally in July, let's just compare ourselves to 2016, okay? Quite a few years ago. In July, they had 6,200 closings. We've only had 5,100, so down 20-ish%. And they went all the way down to 3,800. So I wonder if we break this low of last year, 3,300, and I wonder if we get down into the 2,000s. That will be something to worry about, ladies and gentlemen. And, you know, from the real estate perspective, there's always closings that are happening, but this entire industry, title companies, lenders, real estate agents, home inspectors, appraisers, all need their income based on how many transactions happen, right? Us as agents, we're paid on commission. Lenders are generally paid by how much money they lend out. So if they have a bunch of $1 million deals, it equals the same amount as having a bunch of $200,000 to $300,000 deals. Same thing with agents here, but title companies, they make money based on volume. Same with appraisers, same with inspectors, same with photography companies, staging companies. There's a lot of people involved in real estate transactions that rely on the number of transactions happening. So if this number continues to dip, I don't doubt that we're going to see struggling in title companies specifically, because there's just not as much volume. So we'll pay attention to that, and I will keep you posted on what happens here in the future, as I always do. So going on to the next here, let's look at days in the MLS, and here we go. It is the roller coaster ride. From May was the low up to July, 10 days on the MLS on average for every property. It's really low still, right? 40 to 60 would be kind of normal. We haven't had that in a while. Last year, man, we went all the way up to 35 days on market in January, and that just felt like an eternity. But we're back on the upswing. Everything slows down in fall and winter, okay? Just accept that. Month supply of inventory, we're flat, 2.2 months of inventory based off of June. A balanced market is said to be 4 to 6 months of inventory. But with as many closings as we have, 2 months of inventory, that feels like a lot on the market, even though it's not, just because not as many properties are selling. Shows to pending. It still only takes 9 showings to go under contract, and the amount of showings per listing is down to 6.2. So we usually start to drop here. And so what this means, if it takes 9 showings to go under contract, and we're getting 6 showings per listing per month, it might take 6 weeks to get under contract, folks. Now, something else that I've been focusing on lately, because Denver and the metro area, as well as the foothills, which encompass some of the MLS here, a lot of the properties are over $1 million. So I've been segregating things a little bit more to kind of look at the over $1 million market versus the under $1 million market. And are they painting a different picture? Let's go ahead and look at everything over $1 million and see what that pulls up. So you're not going to get much off a closed price. What we can look at is the amount of listings to hit the market. So what this is saying is that in June we had 1,400 listings hit the market that were $1 million or north, and that dropped down to 1,100. So same as the under million mark. Amount of active listings, that one we're kind of flat as well. Let's expand that out and see what's normal. Now, prices have appreciated so much in the last 5 to 10 years that I'm assuming there's a lot more active over $1 million listings than there have been in the past, which is exactly what this says. We've got quite a few in comparison to previous years. The amount of pending listings, that's up there though. That looks really healthy. That looks a little bit more healthier than the sub 1 million market. And closed listings, again, really healthy. I mean, gosh, look at these last 4 years now going on. It's like we had this normal trend here of, over $1 million properties, and we had, a few dozen close every month, and then bam, 2020 hit, and we instantly more than doubled the amount of closed $1 million plus listings, and then we just kept on going in 2021, and then even 2022. That's just unbelievable. So days in MLS, let's see. I mean, this is incredibly low. 11 days on the market if you're over $1 million. That's kind of crazy. Month supply of inventory is at 4.4. So even though that's considered a balanced market on the north of $1 million market, look at what it's been in the past. So let's go back, 2016? We had over a year's supply of inventory over $1 million back then. That would be 3 times more inventory than we have on the market right now. Just wild. Showings to pending, let's see, 9, same as the under $1 million market, and then showings per listing, 4.7. So a few less here, a few less buyer pools in the over $1 million market than the under. Not surprising. Now, what is driving particularly the amount of closed listings? This is the big thing that we should really be looking at, is how few closings we have. And really, it's being dictated by interest rates. Now, I know what you're saying. How are interest rates affecting the amount of closings? Well, there's less buyers, right? Less people can afford the same home today that they could afford 3 years ago, okay? If that makes sense. If they were approved a few years ago for $500,000 with the same interest rates today, they're probably looking at homes at $350,000. Okay? It just kicked a lot of buyers out of the market that have not been able to return. But the amount of listings is also way down. Why? Well, I can tell you from firsthand experience, because I have a few buyers in this situation, is they're move-up buyers or they're downsizing buyers. Okay, and this means they have a home, they have couple $100,000 in equity because of what the market has done the last few years. However, let's say they own a home that's worth $500,000 and they want to buy a home worth $500,000 in a different part of town. Maybe it's half the amount of home, right? And they're paying $1,500, $1,600, $1,700 a month right now on their current mortgage. And then they're looking at other properties half the size, and they're putting down $200,000 in equity, and they get talking with their lender, and then they find out that their monthly payment is going to be $3,000 a month. Now, what would you do? You've got a 3,000 square foot house, and you want to go down into a 1,500 square foot house. You're paying $1,800 a month right now, and you find out to buy the same price house, you're going to be paying $3,000 plus a month. What do? You do what everybody does. You do nothing. You don't put your house on the market, so that is limiting the amount of new listings hitting the market, and then you don't buy another place. So therefore the closed listings are down. And I mean, I've got 4 right now in that same scenario, and I'm not this big agent who's closing 100 transactions a month. I've got 4 buyers and sellers right now. So I have 8 transactions sitting on the sidelines doing nothing because of what's happening. So if I have that in my business, I guarantee you other agents have that in theirs as well. Do interest rates get into the 8s? No idea. If they do, I think this pattern will continue. Less listings hitting the market because people feel trapped, but also combined with less closings. So we could be flat in real estate prices. If I had to predict, you know what? Let's wait on that for a second because I want to cover this headline out there, which kind of reinforces what I just talked about. And that's from Redfin. They have awesome newsletters that come out multiple times a week. This states that 1% of the nation's homes have changed hands this year, which is the lowest in a decade. So, coming down here, looking at their bullet points, 14 out of every 1,000 homes changed hands in the first half of 2023, compared to 19 of every 1,000 during the same period in 2019 prior to the pandemic. So it doesn't sound like a lot, 14 versus 19, right? But that's a 25% difference in how many people are moving up, are downsizing, are just buying in general. And this is what's driving everything. And the bigger the state, it seems, the more extreme the numbers. Look at California. 6 out of every 1,000 homes changed hands, at least in San Jose in 2023. This is the driver of what's balancing our market. This is our only saving grace right now, folks. If people were in foreclosure distress, if they were losing their jobs, if the job numbers weren't nearly as good as they are, we'd be in a whole lot of trouble right now because with this amount of closings, we would have a lot of properties hitting the market that would just be flooding, and then we would see price races down. But to get to my prediction, where are we going next? If I had to put money on it, I would bet we might be flat in price for the next 2 to 3 years. Okay, I'm not saying that's what's going to happen, but I don't like to be the doom and gloom guy, right? I don't see where any excess inventory would come from to really flood the market, to flush us out, to create any sort of a crash. I think interest rates are high, and I think it's challenging for some markets to continue going up. Now, we could look at some places in the Midwest. Arkansas is a great example. Extremely affordable. You can get a house for under $200,000. You can be in more rural areas easily in the 100s still on land with a decent looking house. But so I think it's going to be market by market. Denver here, we're in a more hyper market. We're in the same grouping with San Francisco and Austin and Seattle, and our volatility is just way, way more. Pueblo's volatility, not half as much as what we experience here in Denver. So I think we're going to have maybe a little bit of a hilly few years, I should say, where we go down 5 to 10% in the fall and the winter months, and then we go up 5 to 10% in the spring into the beginning of summer months. And that's what I would guess until something changes. Something has to crack in order for us to flush. Something has to crack in order for us to go up. If they start slashing interest rates, I actually think that housing is going to get extremely competitive, and I think it's going to be really dangerous, meaning dangerous for young people out there that don't have a home. I think they might get priced out of the market, and we will just become a society of renters, which is not what I want to happen. So it would almost be healthier for us to have more of a price adjustment down 10, 15, 20%, or be flat for a while, let wages catch up to real estate prices so that way we can include more people in home ownership. My advice stays true for anybody wanting to get into the market. Start small, buy what you don't want, where you don't want it, get in, build that equity, and in 5 to 7 years, that's when you take that equity, put it down on the house that you actually want, where you want it. It's going to take patience to break into this market again. So you young people out there, listen to me, do it. do it while you're young, do it while you have the flexibility, and schools are maybe not the highest priority right now. Then in 5 to 7 years, do the typical move up purchase if you can. Once again, I'm Alex Saldani. If you got any questions, feel free to reach out. I'm around. I'm happy to answer whatever you got. And until the next time, happy housing.